Hello and welcome to the FITT Show. How's everybody doing? I'm Bobby Kinzer,
And I'm Thomas Doty.
and we are the FITT Show, financial information for today and tomorrow. Welcome out there in virtual world. We got a whole lot of information today for you, so make sure you call and tune in your family members, your friends. Make sure you share your Facebook Live page and also go out there and subscribe to our YouTube channel. And as always, we want to make sure that you click on the uh, thumbs up button and the heart button so that we can get more traction and reaches more people. That's how Facebook actually works and YouTube. So the more, I mean, at least Facebook, but put comments both on YouTube and on Facebook in the comment box. If you have any things that you want to comment about that we say, or if you have some questions, or if you have some topics that you want to actually talk about, please want us to talk about, please go out there and let us know about it. We're here every Thursday at 8 p.m. Eastern Daylight Time. And like we say, we provide financial information for individuals. We're not financial advisors. We're not certified or licensed. That's why we're just providing general information that hopefully you'll be able to use. And not just you, but your family members, your friends. Make sure you share this information because that's what we're here for. Dude, how you doing today?
I am doing fantastic. Happy to be alive.
That's really, really good, Dote. I'm glad you're alive because you wouldn't be talking to us today. Thank God for that. But it's so much going on, Dote. I mean, last week we had a wonderful, wonderful show. And we're just going to keep on adding information. And we want people to send in, put in the comment box some things. If y'all have questions about some topics you want us to cover, please put those in the comment box. And the more comments you put in the comment box, actually, believe it or not, the more people we're able to reach, because that's how Facebook algorithms work. So help us out there and click on that thumbs up button. Okay, now we've gotten through with the administrative things. Let's talk about the stock market, though. It's been beating people up for the last few months. How is it going today?
Yeah, it's been a pretty good week. Hey, I popped the chart up there. We can show some positive news for a change. It seemed like every Thursday the market would take a spill, but
Well, I'm
this week,
sorry, Dope, but I don't have the chart today, my man.
okay. Well, I'll have to talk to it then. Uh, Let me see. Hold on, I have it right
Okay.
here.
Oh, you actually sent it to me, didn't you?
Yeah, I did. I think I did.
Okay. Okay. I didn't know you did.
Well, you
I
give
can
your
pull it up.
cryptocurrency, and I'll come back to the charts.
Okay. Now I was going to look and see the chart. I don't see that you sent it to me. I was going to pull a chart up. But if you got it, you can actually share it. So let me tell you about cryptocurrency, you all. So, well, yeah, let's talk about cryptocurrency. Now, cryptocurrency has been taking a beating. I mean, it plummeted. But man, let me tell you, Dota is coming back. Uh, the market cap now is over $1 trillion, back up to over $1 trillion for the total cryptocurrencies out there. And don't remember last time I talked to people and I said it was about 15,000 cryptocurrencies. It's now up to 18,000 cryptocurrency. But like we always talk about, always pay attention to the top 10 because those are the ones that seem to be a little bit more structured and stable. But the Bitcoin last week was at $20,491. Though today at 7 p.m. is at $23,193. That's up $2,702 per Bitcoin. That's a big jump. Bitcoin is still ranked number one. They were selling off a lot. Last week, the market cap for Bitcoins was at 391 billion. It's up to 442 billion. So people are jumping back in, though. I guess all the people who've been taking all those profits and everything are jumping out. Shiba Inu, that's even up. They starting to get back in there. And then the Dogecoin starting to get back. People starting to jump back into these cryptocurrencies, though. So that's a good thing for the crypto market.
Well, in the past week, the market has had several good days. Dow is actually up 1,400 points versus last week. That's about 4.6%. NASDAQ's up even more. It's up 809 points, but that's a 7% increase. And some of the stocks that I have had a pretty good week. It's a lot of it's just going up and down and back and forth. So but overall, it's been a pretty good week. Microsoft's up to 265. It went up 11 points in the last week. The big mover was Tesla. Tesla's up 100 points over last week. That's correct. 100 points, 14%. It went from 715 to 815, which is a big jump.
Wow.
Apple's up 4.7%. It's up 7 points, and Pfizer is pretty much flat. So all in all, it's a good week. But again, remember, the Dow and NASDAQ both are down a huge amount this year. So we're hoping this is going to be a positive trend. I see people, gas prices are going down, and there's been some positive news, but this thing's still going to be volatile as we go forward, and there'll be a lot more of the ups and downs.
Well, dope. You know that semiconductor stock that I had called NXP. Man, that's up $20 a share. And the Ford. Remember I told you last week it was $159.82 a share. Today it's up to $179.95 a share.
Holy cow! That's a pretty healthy increase.
Yeah, and
4% increase.
Yeah, remember I told you Ford was down to $11 last week and is up to $13 this week.
So you even? You back even with Ford?
No, I'm ahead. I got in at $12 a share.
Oh, cool.
So I'm actually ahead. Yeah. So that's doing pretty good. But you know, this market, man, like we say, remember y'all, it's all about the long play. And we're going to be talking about dispelling some of these myths though, because there's so much information out there that is misinformation, you know?
And some of it just gets passed, passed around like it's fact, but it really isn't.
Yeah, and so that's why this week we want to talk about dispelling some of those myths about investing, because it's just so many out there, man. I mean, and a lot of it, dope, is put out there, and it's not easy to tell whether it's true or false. And sometimes, it's especially difficult because some people put it out there as wisdom, and they keep repeating it like a parrot. So oftentimes it seems true. But, even if it's based on misinformation or misconception. So, so what we're going to try to do today is hopefully, cut through some of the noise from the truth and come up with some of the most common investing myths that the experts want to dispel. And,
yeah. And Bob, there's so many out there. There's so much financial information out there, and a lot of it is good information. I mean, you can look at Kiplinger, you can look at CNBC, and those are reputable sources for information. But you get a lot of things that are, let's call it water cooler talk, and people pass it around like it's fact when it's just what somebody thinks or somebody's opinion or somebody's guess as to what's going to happen. And that's what we're trying to get you to avoid, and just use, sound principles in your investing to reap the benefits. But a lot of the stuff that's out there isn't facts. It's simple as that. Like as Bob said, they're just myths.
Yeah. So, so tonight, now we know you've likely heard a lot of these before, or you might even believe some of these daggone myths. But we're here to tell you tonight, don't believe them anymore. So we want to start off. Don't want you kick us off with the first.
Okay, yeah, and the first one, and some of these we've talked about, and we might have even been spreading the myth by not giving a lot more detail. By not giving a lot more detail. For example, this one, the first one is you should pay off debt before you start investing. And I think we've said that, but ours is more concerned if you're talking about like 20 something percent interest rates or 17, 18% interest rates. But just to make that statement, you should pay off your debt before you're investing, before you start investing. And it's really not true, because if for example, you have a 5% student loan that you're paying off, and you sincerely feel that the market, we always talk about the market averages between 8 and 10% a year. If you can invest at, let's say, 8% versus paying off a 5% loan, you'll be better off. And the way to look at it, as each dollar you pay on debt is like an investment. You have to look at just as you would any other investment. And if the cost of investing or the cost of the interest is 5%, and you feel you can do better than 5%, which again, if you invest in the market over the long term, the market does average somewhere between 8 and 11, 8 and 11%, then theoretically you should just pay the minimum amount on that student loan. You always want to at least pay the minimum so you don't incur any late fees or uh, don't run into trouble by not paying the minimum. But any additional dollars, if you can do better, for example, like say we talked about savings bonds are paying 9% now. It doesn't make sense to pay off a 5% debt if you can get a higher percent elsewhere. So in theory, it makes sense to pay your debt off first, but in reality, you have to look at each situation. And if you are paying off, you wouldn't want to pay off a low interest rate when you can take that money and invest it and do better. Again, don't default, don't be late, don't not pay your bills, but understand your cash flows, understand what your money is, what your money's doing, and make the best decision for your particular situation.
And it's so interesting, though. That's the whole theory with America now, because a lot of people was talking about, the amount of debt that America is in. I mean, it's over like $21 trillion, the actual national debt is. But what the big players in the American economy says, but it's cheap debt. At one time, up to now, recently, our bonds has just went up and we're paying 3%, but it was down as low as like 2% or 1.5%, and that's low debt. That's a perfect example, like the American treasuries. People were borrowing our money, and they're like, "Whoa, wait a minute." But other countries like Greece and Portugal that had bonds paying like 15%, but they know they would default. They would buy Americans 2% because they knew they were going to get it, and that's considered low debt servicing. A lot of people didn't understand that when they heard about America being in so much debt with the bonds, but we service a low debt. So it works the same thing with us individually. If you got low debt, very low interest rates, it might sometimes better to keep that low interest rate and use the difference, like Doe said. But I want to talk about one big.
One more thing, it's kind of funny too, because if ever you want to be in debt, it's in inflationary times, because it just like everything else loses value, so does your debt when you have debt during inflationary times. So,
right, isn't that interesting though? Though people don't realize that.
Yeah, it's crazy.
Yeah,
it's crazy.
Hey, another big investing myth though. You need to be rich to invest. And I know a lot of people, especially when I was started off being a stockbroker and investment advisor in the 80s, the mid 80s, man. And I was doing, financial planning and asset management. People thought that was only for the rich people. No, that is one common investing myth that really eats at people. That only the super wealthy can have, can play in the stock market, and that's not true. Because there's multiple studies that show that more than half of Americans invest in stocks. Like the Federal Reserve's most recent survey of consumer finance by the Federal Reserve, released in 2019, found that 53% of families own stocks. I was kind of shocked at that, though. And a more recent Gallup poll conducted in April of 2022 found that the number is even higher at 58%. And I was like, wow, because I thought, more people didn't invest. Well, I didn't think that many people were investing into the stock market, especially equities. And it's easily more than 50% of working population is relying on the stock market in their retirement savings, which is the way that the way more than only the richest in the United States populations do. Most of these studies do not consider the numerous pension funds, though, that people are invested in the stock markets, such as the California's Teachers Pension Fund, which used to be one of the largest stockholders in Teslas, and people didn't even know that they had Tesla stock. So that's another myth that only the rich, really invest in the stock market. But why is this investing myth so persuasive, so pervasive? Excuse me. It's because it's become a rallying point. And a lot of politicians over the decade, though, where they constantly cry that the stock market only benefits the wealthy, amongst us. And the challenge is to prove the validity of the statement. It creates a false narrative that can be discouraging for a lot of people. For instance, I saw an article yesterday, though, that spoke about how Black Black Americans were the biggest losers in the cryptocurrency. And no, it didn't say losers. It said it was affected the most. It didn't say losing. It said it affected us the most. But yet I knew people Black Americans, who made out in cryptocurrencies in a big way, several people. But they tend to discourage us, from investing in all the time. The rich people and the big money people, they could discouraging the politicians, discouraging people to get in the market, and they all up in the market with inside trade and everything. So
Yeah, but some of that is understandable because the more money you have, the more you can take and be risky with. And so that's one advantage the rich people do have, is that they can take a portion of their money and invest it in things that might generate a higher return. But it still doesn't stop. No matter the point you're making, no matter how much money you have, you should be investing in the market. That's what we've been talking about in just about every show we've done.
And what I was always taught as a stockbroker or financial advisor, they told us it's not what you make, it's what you do with what you make. And I had a big debate with a friend of mine the other day. He said, Bob, everybody can't be in the stock market. I said, yeah, but everybody can't risk not getting the benefits of being in the stock market. He said,
You
I
can't
said,
afford not to be. That's right.
yes, and understand that everybody can't be in it, and everybody, doesn't have discretionary income. But when I talk to a lot of people and they do a budget, you find that a lot of people are spending money on frivolous stuff, man. And they talk about, they don't have the money to be in the stock market. I have friends that pay $50, $100 a week in the lottery, and to invest $50 or $100 a month in your retirement plan, it will add up over time and help prepare you for a better future just doing that. But the misconceptions is about people, like being afraid of the stock market.
Yeah, and that's one where a lot of people think investing in the stock market is like playing the lottery, because they don't have the information, and they don't take the time to learn about it, to understand what they need to know. So it's really not like the lottery, in which you have one chance in a gazillion. Just looking at long-term results, the stock market is averaged. I don't know the exact number. I think it's somewhere between 8 and 11%, but the stock
Right.
market has paid a pretty healthy return since its inception. Okay, another one, and again, this is another one that we're a little bit guilty of. People always think that the higher the risk, the higher return. We joke about no risk it, no biscuit. And again, in general, it's correct, but it takes some more explanation. And you tend to think that the more risk you take, the higher your return can be. And that's not necessarily so. And you can understand why you can feel that way. But if you break it down a little further, risk in investing is measured by volatility. and that's the degree in which about an investment can change in value. Okay, and we told you a little bit about beta. That's the measurement that talks about a stock's volatility. It measures how the stock changes in relation to the market. And so when we talk about volatility, we talk about how much it swings. And the swings could be up or down. So just because it's volatile doesn't necessarily mean you get a high return. And that's what you need to understand is if you're going to invest in a stock, you need to understand its beta. It needs to have sound financials. And Bob always talks about looking at the management team and seeing how much they're invested. So you make an educated investment if you look at those things. You don't just get risk just to say I got something risky and I'm going to make a lot of money. And that's what you need to understand. Volatility measures how much it changes. And just because it's volatile doesn't mean it's necessarily risky.
And that you're talking about risk now, Dote, I think that's another term that people confuse with risk capacity, because risk tolerance is how much risk you're willing to take. And that means like being conservative, being moderate, or being aggressive. But there's risk capacity, meaning your portfolio could be in a whole lot of risky things and you don't have it balanced correctly. And that's two different things. Like volatility is different than your risk tolerance. You don't want to have everything in high aggressive growth. An aggressive growth portfolio. That's risk capacity. So understand risk tolerance. That's how much risk you're willing to take, be it aggressive, moderate, or conservative. And risk capacity is the actual how much the balance of the risk that you have. Though another myth is the more stocks or funds you own, the better diversified you are. Now, we always talk about don't put all your eggs in one basket. That's why we always been for like mutual funds, because it's a diversified portfolio of funds. But you almost certainly need to diversify, but diversify is just one way to mitigate the risk. And it's true, but when you invest in a large number of stocks or bonds or other assets, there is less of a chance for your portfolio to plunge or to drop, because you have or the market to have a significant impact on your portfolio. But the problem is that people misconceive being what it means to be truly diversified. Diversification is less about numbers and more about the character game, meaning because you have a large group of stocks from one sector, it doesn't offer less diversification than a smaller group of stocks in several sectors. For instance, if you got if you got your stocks in 100 technology companies, then your whole portfolio is substance to that particular sector. And you may have several different companies, but it's not diversified as far as it comes from the different sectors. But a portfolio with one tech company and one financial company will be more diversified and lead you to less exposure. For instance, the same holds true if you have many people pick a lot of funds because they feel it's spread around. But while funds do generally give broad exposure to many different sectors, you might end up owning the same funds, which are owned by the same companies. And when they charge fees, then you could be hit very large with all these fees, but it's all from the same company. It's just that you got different funds for the same company. That doesn't mean you are fully or adequately diversified. Or if you think you're more diversified because you got 5 S&P index funds, you actually ended up putting yourself in the same situation. And these funds could be overlapped in companies and cost you more in the long run. So beware of that, because to be truly diversified, look at investments across that are going in different directions, meaning, they could be diversified in techs or they can be diversified in financial companies, or they can be diversified in energy. But try to diversify. Just because you have a bunch of stocks doesn't mean that you fully diversified if they're all in the same sector.
And plus, you have regions, Bob. You also have,
Yes,
you know, being in a European market or an Asian market or a South American market also increases your diversification because those economies differently, I mean, definitely move in different directions at different times. So you're spreading your risk even wider when you diversify regionally.
that's another one. And then into, like you said, then into international stocks. Just being, in U.S. stocks. Another diversification is international stocks because, what happens in our economy, things happen different in other people's economies, and you can diversify that way too. But though, Joanne Skinner, who always checking in on us, said some people just don't know how to start. What do you think
How
that?
to
What do you
what?
say to that? Do not.
What did you
Some
say?
people don't know how to start
How to
with
start?
investing.
The easiest way is to figure out how much you can afford to invest. And as we always talk about, you don't invest your bill money, the money that you got to pay your bills with. And typically, you wouldn't invest money that you'll need within the next year or two. But you start off with some sort of index fund, some broad-based S&P 500 index fund, and you start making consistent periodic investments in that. And the easiest way is have it through payroll deduction or have an automatic deduction out of your checking account monthly. We've talked about the benefits of doing it monthly because you get to take advantage of what we call dollar cost averaging. Is, for example, if a stock price is going down and you're putting in $100 a month, if it's going down, you're buying more shares. At the same time, if the stock price is going up, you're buying less shares when the prices are higher. So you want to get into periodic, consistent investing over the long haul, and you don't want to be worried about uh, pulling it out 6 months from now. As Bob always says, this is about the long-term play. So you want to have some sort of systematic investing mechanism, be it payroll deduction or automatic out of your checking account, and you want to invest in a broad-based index fund to just something that just mirrors the market. Now, if you decide to invest in individual stocks, that's a whole nother bunch of steps you need to take as far as understanding your risk, understanding what that stock's about, looking at what their future earnings are going to be, looking at their financials, looking at their management team. There's a lot of what's the word I'm looking for? A lot of time you need to spend uh, finding out or understanding what that company is doing if you're going to invest in a individual stock. And that's why we would say for someone just starting off, a S&P 500 index fund is the way to go.
Because that's what you're paying them. It's a management company. That's what mutual fund means. Index fund means that's a management company that's managing your money. So I would definitely, like Doe say, if you're just starting off, or invest more into your 401k plan. But one of the first things you need to do also in starting off, you need to determine what is your risk tolerance, how much risk you're willing to take. And then you need to determine what goal. Is it to build for your retirement fund? Is it to pay for your kids' school? Is it to buy a new house, buy a car? Whatever it is, think of what the goal is, and then that determines in the risk. Then that determines the particular products that you need to be invested in. Are you going to be investing for 5 years? Is it going to be investing for 10 years, 15 years? Because that determines the type of product. So you definitely need to determine what financial goals you have and how much risk you're willing to take. And like Doe said, then you need to determine how much money that you have that you can actually put away without having to worry about um, needing for emergencies. So
Yeah, and Bob, a couple of things that during my work career used to drive me crazy when I was early in my career, when I was a plant controller and could see who was investing in the savings plan. And so a lot of people weren't investing in the savings plan. And that just drove me crazy because the company was matching 6% and people weren't saving. So that was one issue, not saving. And then the second thing was people who wouldn't take the time to understand what the different options were within their company savings plan. And a lot of people would take the fixed income investment because it was a guaranteed fixed income. And again, all this goes into your age. If you're young, you should be obviously taking more risk because you have a lot of time to make it up, a lot of time for the market to go up and down and up and down. But over the long term, you're going to be okay. And then the third thing that used to drive me crazy is people taking the money out to do stupid things. And shouldn't say stupid things, to do things that they thought were important that I thought shouldn't, that I thought weren't important. Like, you're saving that money, is what I'm saying. It's for a purpose. Is it for retirement? Is it to pay for college? So you just can't pull it out on a whim, to take a vacation here or there, unless you plan to do that. So those are the three things that drove me crazy: people who weren't saving, people who weren't paying attention to who did save but weren't paying attention to where their investment was going. They weren't making a sound decision as to where to put the money, and finally, people who are so quick to take it out. And if you can get past those three, and you're starting off in a company, you're going to do okay over the long term.
Though, and that brings up another thought to me, is I had a lot of people that didn't even understand the implications of their um, 401k plans, because they would take it out, and especially if you can take it out for hardship and things like that, and they were taking it out and didn't know that they were paying a penalty on it, or didn't know they had to pay taxes on it, especially with the pandemic, because the pandemic gave a lot of forgiveness. Like they forgave the 10% penalty, but they didn't get rid of the paying the taxes. So I know a lot of people didn't understand what they were in, or they cashed out of their stocks and didn't realize, or the cryptocurrency didn't realize they created a tax implication. So you need to understand these things, and that's why most people, a lot of people, it's just knowledge, and that's why we're here, though. That's what we talk about every week. We trying to make people more knowledgeable, and especially with these myths about investing out there, those are just as dangerous to people as the positive information that's out there.
Yeah. Okay. And the next one is one we've talked about over and over, and I think we'll probably continue to talk about it because it's so important. And that's the myth that you can time the market. And we've warned against this all the time. People thinking they know when to get out, or I think things are turning bad, so I'm going to get out of the market, or I think this is the time to get in the market. It's funny because the bull market for the last several years, up until this year, everybody became a stock expert because most of what everybody bought went up. No matter, just about whatever stock you bought went up. So everybody think they became an expert, and they would get in and get out and talk about how much money they made. But everybody was making money in this market. So no, you weren't doing anything special. But it's no way you can know when to get into the market and when to get out. And if you think about it, it's you got to be real good twice, because you got to know when to get in, and then you got to know when to get out. And nobody can predict the future. You can look at history and you can say, okay, this has a high likelihood of happening, but nobody knows what's going to happen in the future. And again, for you to be able to guess when to get out and when to get back in, and even if you do that once, you're still minimizing what you could make over the long term. And so it's just not a good play. And BNY Mellon did a study that talked about, and I think we talked about this before. If you missed between 2000 and between the year 2000 and the year 2020, if you just missed three of the best performing days, that would take 1.5% off your return. And you start talking more days, you start talking a bigger percentage of money that you miss. It's just nobody's good enough to do it. You invest for the long term, and you don't worry about trying to figure out when to get in and when to get out, because professionals don't know, so there's no way that you know. Okay.
That's good. That's good. That's good stuff, though. That's great information, man. Let me tell you another one, though. That this is a big one, and we talk about this and doing it, but one of the myths of investing is you must constantly monitor the market to be a successful investor. Now, one of the most commonly things done in investing is how much research you should be involved in. And not only that do you have to determine what is the right investment, you need to also keep an eye on the news, the financial news, the stock charts, the fundamental analysis, the technical analysis, the background you can make to make good decisions at the moment. All this sounds like a headache, and that's why a lot of people feel that they are over inundated with information and it feels like it's getting ready to explode their head. But really, it's really unnecessary. Investors can be quite successful with the set it and forget it mentality. In fact, hovering over your portfolio can do more harm, because sometimes you overreact when you hear all of this different information that the market is going down, and then you're missing on underlying trends, or there's shifts in the market, and it's the new term though called FOMO, fear of missing out. A lot of people get that, and then there's excessive trading that may lead to lower realized returns. So, yes, we do believe that the more information you have, the better you are, and you should always know what you invested in. But there is a point where you don't have to be doing no technical analysis, but we do believe you should keep an eye on your investments and you should understand them, but you don't have to go as far as having all of these charts, looking at it every day. Some people do, but some people it causes stress because as soon as they hear all this market noise that's negative, they want to run quick and make some bad decisions, and that's not good. So investors, don't need to be quick to react to information. It's just that it is suggested that you develop a solid rationale behind your investments and then also get a qualified second opinion before acting. That will give you enough foundation to be able to keep track and knowledge of your portfolio.
And the next one is one I didn't know much about, but learned something new here. In ESG investing, and a lot of people, one of the myths is that it doesn't really have an impact. ESG stands for environmental, social, and governance. And the governance relates to corporate governance. And a lot of people think, well, just because I buy a stock in a socially responsible company, it won't really have an effect. But it truly does. And so the individual investor can have a effect on things just by investing in a company that's doing things that a company should be doing. And a lot of people think, well, I'm just buying one stock. But if you are, you can make an impact by investing, even if you only buy a few shares of stock. And the first is if you put money with an ESG fund manager who's actively engaged with companies, that's supporting their work and giving them more clout, and they can make the positive changes that people would like to see made as far as environmental, social, and governance is concerned. And you can invest proactively in companies that provide tangible solutions. That kind of, again, gives them momentum and encouragement to keep doing things such as using less energy, or working on gender equality, or resource efficiency, and things of that sort. And finally, you can pick an ESG bond fund, and they invest in impact bonds, and they have a direct and measurable effect on economic development. And it could be affordable housing or decarbonization, or whatever the case may be. And so even if you only buy a few shares of stock in a company that's socially responsible, it can make a difference. And even though it's only one or two shares, it can make a difference. So if you are so inclined to invest in a socially responsible company, don't feel like you're not making a difference, because you are.
And though it kind of makes sense, because I worked for the Calvary Group in the 80s, and we were the first one to ever have a socially investment fund. And I was wondering, was with people, but why would you want to invest in companies that are polluting, putting pollutants in the water, putting pollutants in the air, have bad civil workman rights, and I know people don't think about that, but that's what ESG funds are considering. Look at companies that have good track records with, their employees, because I mean, like I said, when I was doing it, though, I was kind of shocked how many people were socially conscious about where their money was going, because they're like, we know it's all about increasing your gains and making more money. But some people would like to be investing in a company that's not adding to social unrest within the company. So ESG funds, and a lot of people don't think that they make out, but they do. They have, and it's been proven since 1985, when we came out with the first socially investment fund. And it is true, but it's not for everybody, but it is a myth that you can't make money in ESG funds, and you actually can.
And Bob, I personally, I had money in a Wells Fargo account, and read an article that their chairman was talking about their lack of diversity, and made the comment that he couldn't find qualified African Americans, and that so insulted me. I went to the bank and pulled my money out, and the lady asked me why, and I told her, and I ended up getting a letter from some muckety muck in Wells Fargo, and was telling me that it wasn't said the right way, kind of admitting they made a mistake by making that statement. Because when you spend 41 years in a corporate world, you hear that oftentimes, and it's not true, because I don't want to get off the subject, but it's not true, because as you move up the ranks, and in the back of your mind, you're thinking, well, the folks at the top must be brilliant. And then when you start moving up the chain and realizing they ain't no smarter than nobody else, and a lot of them are average, and there was always that pushback against hiring average Black folks, and it used to drive me crazy that we could have average white folks, but we can't have average Black folks. And so that comment just kind of hit me to my heart, and I'm like, I'm pulling my money out of here. And to me, that was socially investing. That's what I was doing. So
And we need to be more conscious of that, though, because people need to be more socially responsible and more accountable, and hold people accountable, because that way we'll have a better environment, a better culture, because a lot of people let things pass. But don't you bring me to the story when they say that Staffers stay around the water cooler and talk about football and basketball. Managers, they stand around talking about baseball. And top executives, they mess around and they be talking about golf. You know what the moral of the story is? The higher up you go, the smaller your balls get. I ain't lying. So anyway, with that with that statement though, I just want to say uh, be socially responsible, y'all. Just don't let people just get away with doing things. And though, before we get into our summary and takeaways of today's topic, I want to shout out to the wonderful Joanne Skinner for joining us. She said, thanks for great information. And my wonderful sister, Gloria Kinza Browner, thank you for tuning in, especially out there on YouTube. We like to be out there on YouTube to show our presence. And now, Dodie, wait, now what's up now? We got Ursula Owens. And look, Taria's out there, Dodie. I was shocked. Taria's out there. All right, Taria, glad you out there. And happy anniversary, Taria. So, Dope, with that, let's go to the video. All right, Dope, let's start off. I'll kick it off with don't believe everything you've heard. There's so much misinformation, and there's three main things that people struggle with their finances. They fail to make plans, they have misinformation, and they lack information. So watch out for that misinformation because there's so much false information going out there. Vet it, go out there, ask the second person, ask a certified person who is knowledgeable, and make sure you clarify some of these myths that they be putting out there.
Be strategic with what you have. And by strategic, we mean have a plan, have an understanding of where your money's going, have an understanding of what you're investing in, have an understanding of your risk tolerance. Put as much effort into your financial being as you do into vacations or other important parts of your life, and you'll reap the benefits.
Remember, it's not how much you make, it's what you do with what you make. Now, diversification is more than just numbers. It's more than just having a whole bunch of different stocks, whole bunch of stocks that's in the same sector. Make sure you're diversified, that you have stocks that are going and complementing each other stocks by going in different directions. Meaning, you should have some growth funds, you should have some income, balance fund, you should have some tech, you should have some financial. Mix it up. And one of the best ways is to have a index fund or a mutual fund. That really helps you. But just don't think you get all of these, like a lot of the millennials or Generation Z don't have. I know a young guy said he had 50 cryptocurrencies. And that's not diversifying. That's not diversifying because you're all in the cryptocurrency and they all are speculative. So be careful with that diversification. It's not just about numbers.
Finally, trying to time the market is stupid. I mean, fruitless. Stupid is a better word. It's like people can tell you the person who told you, oh, I got in and got out, just like people can tell you the person who hit the lotto. But nobody will tell you all the times they lost playing the lotto, all the people who lost playing the lotto, and just like all the people who lost trying to time the market. It's not worth it. You can't do it. Stop trying to do it.
Yeah, that's why I never understood people that gamble. They always tell you about how much they made, but they never tell you about how much they lost.
Nope.
I never understood that.
Nope.
But another good show, Dote. I hope that helped dispel a lot of the investing myths out there. If you have any questions, please put them in our comment box. Even when we go off here, you can go out there on Facebook Live, and this is archived, and you still can put comments out there. And also the same thing with YouTube. We're always looking for different things to talk about each week. We hope this Dope. This is our 60th show, by the way.
Wow.
60. consecutive. I think we missed maybe one show out of the 60. I mean, really was, yeah, no, we did 60 shows. We only missed one show out of the consecutive weeks. So we just make sure you all out there, make sure you understand what you're investing in, you know your risks, you set your goals, and go for it. There's no limit to the amount of money that you can build and help create your wealth so that you have generational wealth, because that's what this is about, y'all. Just don't take this information and use it for yourself. Pass it along. You can go out on Facebook and you can share this. And people have been doing it. And first of all, I want to thank, there's a lot of people that's been sharing our sites out there. We've been reaching anywhere between 150 to 200 people a week. So thank all the people that have been out there tuning in, especially my friends overseas in Scotland and England. Thank you for tuning in, because I know that means y'all up until 1 and 2 in the morning. So thank you all for doing it. And make sure every week we hear the FITT Show, financial information for today and tomorrow. Y'all have a good weekend, and we see you next week.